Hey friends, Amy Irvine here. Just giving you a quick update from the Rooted Planning Group Monthly Chartbook. Hopefully this won't be too long, and if you have any questions, of course, we want you to reach out to us, but we are trying to keep you as informed as possible with everything that's going on right now, both in the stock market as well as in the economy. So if there's more information you want, we would love to hear more of what you're looking for. Certainly, you've probably heard that this year has not been the greatest year in the stock market. As you can see by this chart, it is down about 18.2% year to date. That's not the lowest point, but that's approximately what it's down as of Friday. For long-term investors, it's certainly important to maintain the proper perspective and look past the short-term volatility that's going on and look long-term. So even despite the bear market this year, the stock market has rallied significantly over the past 2 years. And if you look back on the chart that I'm showing to you, it shows you several corrections that have taken place since 2016, and yet the market has grown even from the trough to the trough that we're seeing right now. When it comes to stock market cycles, I think this is always something that, people feel very uncomfortable when the cycle is happening, right? So the stock market has fallen into bear market area, although the Dow is still in just what's called correction territory. Where the Dow goes from here will completely depend upon corporate earnings, interest rates, and the Fed's global political risk. We'll know more coming into this month and later this month because earnings news will start to come out. But I think it's interesting when you look at this chart, even when you look at from the bottom of 2009 to now, or even just prior to when we started to correct in 2007, if you looked from there to where we are right now, which is post bear market, it's still over that period of time an increase. And when you look at the returns that we're talking about, you see that since the bottom of March 2009 to today, 13 years and 4 months, that particular, the stock market cycle is up 379%. That's pretty significant. I know that's not a short period of time either, but it's pretty significant increase. And we can never guarantee that kind of thing, but I think it's important for people to understand that although it feels bad in these kinds of markets, there is lots of opportunity. One of the things that's most interesting to me that I've been watching, just as an FYI to folks, some of the things I keep an eye on, is the S&P moving average. So this is the 50, 100-day, and 200-day moving averages. And if you notice, there has been a crossover right here with the 50-day moving average, well, actually the 200-day moving average, 50-day moving average, and the 100-day moving average. There's that crossover that has actually happened to say that the moving averages perhaps are consolidating. So the 50-day moving average is showing how the market has been behaving recently, while the 100 and 200-day averages show a longer term trend. So for me, it was very interesting to see that the 200-day trend is actually, I should say the 50-day trend actually crossed over, and the 100-day trend crossed over the 200-day trend. So something that we'll be looking at and to see what these averages do going forward. Will they continue to decline? Will this be the turning point? As I said, this isn't the lowest point that the market has been, but still, when we look at where the moving averages are right now, the 50-day is still on a downward trend, and we'll see what happens going forward. Another important thing that I think people should pay attention to is the market price to earnings ratio. So the historical average is about 15.5%. We've been in several situations, we've been overpriced. In fact, for a period of time, we've been overpriced, except when COVID hit. And now it's coming back more in line with what the historical average is. So to me, that makes me wonder, are we getting close to that bottom? You can see during the financial crisis, it was a lot lower than that, but there was a lot more going on in our economy than what's going on right now, in my opinion. negative. And then also looking at the index valuations 1 year ago today in ranges since 2003, and US stock valuations have improved. So they have improved. Valuations were previously near historic highs. So rising earnings have also brought valuations down, and investors should remain properly diversified, we think, among US and abroad due to these valuation differences. But it was interesting to me to see that see what the valuations are and how close that they've actually and how the standard deviation is actually consolidated. This chart I like to show a lot of folks because it shows the total return and the pullbacks. So this is, as I mentioned earlier, right now, as of Friday, the market was down about 18%. The lowest point this year was down about 23%. You'll notice that every single year that's on this chart has some negative max drawdowns within that year, meaning there's an average that happens every single year where within that particular market there might be a decline or an intra-year decline. So every single year has one of those intra-year declines. Some are just more significant than others. And I just want to point that out because most people don't remember that, like say for instance, last year had any kind of intra-year decline, but it actually did. So did 2019 and like I said, every year. So even though the positive returns, which are on the upside bars here, had positive returns for the year, and then these few that had negatives, there was still negatives within that year. And I just think that's really interesting for people to learn from. Typically what we see, and I know a few of you have seen this chart many times, but this is a market correction and recovery of the S&P 500 since World War II. The market on average falls about 14.3% in a correction, and it usually takes about 5 months from peak to trough. And then once the recovery starts, it only takes about 4 months, which is why we always are telling people to stay invested, because once it starts, it goes very quickly. The same is true of bear markets and recoveries. The S&P 500 total return since World War II, bear markets peak to trough decline about 20% or worse. The bold line you see is the average across the bear markets, and the markets fall on average 34.6% in a true bear market, and the average recovery takes about 2 years. That's why I was saying 16 to 18 months in total. So if you're looking at that particular period of time, recoveries from this level take about 2 years and 5 months. But once they start pretty rapidly, because the recovery from the recent crash was only 6 months. You often hear from us, stay invested. And the reason that we say stay invested or stay fully invested is because if you miss the best day, you're giving up $400 in a situation where you initially invested $1,000, it became $3,500, and then you pulled out and missed the best day of the market. The difference in your return is $400. But if you pull out and sit on the sidelines until things get better, then you end up having a lot less than what you actually invested. So that's why we're always saying to you, even though it doesn't feel good to stay invested, we encourage you to do that because the return ends up being better. And earlier I showed you a chart that was just the S&P 500, and this one actually shows global returns and pullbacks. So again, you'll see all of these years as the performance is listed, and even in the positive years there were drawdowns. So you'll see those little red dots that show that even in those positive years that were positive for the entire year, almost every year experiences a significant intra-year decline, even though they end in positive territory. So again, just want to show that to you so you understand why we say stay invested. We hope you found this information helpful. As always, if you have any questions whatsoever, please don't hesitate to reach out to us. Here's a few definitions and some terminology that I may have used. If there's something particular you want to hear from us, please let us know. We're here for you. Thank you all.